A big sell-off across the board this afternoon. The Dow tumbling 595 points at this point, with just around 2 hours left in the trading day. It's in the red for a second day in a row, and this, of course, comes after yesterday's historic plunge in oil prices. Now, the May contract for crude is back in the green today, but we are seeing pressure in the June and July contracts, and that is what investors are focused on this afternoon. Now, the June contract down about 60% today alone, hitting a low of $6.50 a barrel. Now, June, some say, is a better indication of where traders think oil is heading here in the short term, just because it is more actively traded than that May contract, which is expiring today. At this point, sector-wise, we are seeing all 11 of the S&P sectors in the red today, but it's interesting. Energy is actually not the worst performer so far this afternoon. We're seeing the biggest declines in technology and in financials. Well, first, we have to get to the latest on this oil rout that we are experiencing, and for that, we have Richard Swann. He's head of price reporting at S&P Global Platts Americas. And Richard, thanks so much for taking the time to join the show this afternoon. First, I have to get your reaction to the move that we've seen in energy over the past couple of days, especially that huge move to the downside yesterday. First time in history that we've seen crude cross over into negative territory. Is this something that you saw just as possible at this point?
I'd love to say yes. Great to be with you, Swann. Yes, negative prices can happen in commodity markets, but to be honest, they only ever normally happen when you've got like an unwanted byproduct. Say like gas in West Texas. You really want to pump crude, but you get some gas with it. You've got to give the gas away at a negative price. This was the benchmark. This was crude in Cushing. So although technically it's positive, I don't think anyone really saw it coming. And the pace and the scale of the decline yesterday was just staggering. Minus $40. I mean, just let that sink in. I'm going to give you $40 to take this barrel of crude off my hands.
Yeah, Richard, when you put it that way, it's incredible. I mean, you have to literally pay somebody to take crude off your hands. When we talk about what the implications are of this, given that this is one of the most widely watched and widely used reference prices out there, what are the implications?
So there's some interesting things to think about here. Firstly, to really understand what happened, we've got to look at this particular oil price. So we all talk about WTI futures, NYMEX crude. It's based at one specific location. It's a very big location in Cushing, Oklahoma. Probably the world's biggest commercial kind of storage facility, and lots of pipelines and storage tanks all interconnected. It's a lot of infrastructure there, but it is one specific place. Historically, the whole of the US oil market, and indeed beyond that in some parts of the rest of the Americas, have used that price as their reference price. It's been pretty stable, and that works pretty well on the whole. So if you're trading down in Houston, where I'm based here, you can trade Houston barrels at a difference, at a premium or a discount to Cushing. The problem is yesterday, Cushing can get under real stress. The futures contract, this is really important, is physically settled. When the May contract expires today, if you are holding open interest, if you've gone long that contract, you have to take physical delivery of the oil. You have to have a tank to put it in. Really simple stuff, but commodity markets are physical at their heart. The problem is, firstly, for the physical players, tank space is running out. Because of the huge drop in demand from coronavirus, world oil supply is running way over demand and has been for weeks and weeks now. That surplus has been going into storage one way or another, crude or refined products. Somewhere it's going into storage. There's a limit to how long you can do that for. And as storage gets full, it gets very hard. I don't want to buy any more crude because I've got no tank to put it in. Also, think about this. Who's trading these futures contracts? It's a massively successful futures benchmark, crude at Cushing on NYMEX. A lot of the money in there trading in and out of that contract every day is not physical oil companies. This is financial investment. Right? These companies, if you're trading for financial reasons, that contract is a perfectly valid investment vehicle for you. You cannot take physical delivery of crude. A hedge fund doesn't want to get its hands wet with oil. You have to close your positions. So you've got to roll your June exposure, either close it out totally, or your May position, or roll it into June. But what happens when no one wants to buy the oil? You end up offering literally into a vacuum. There are no bids, and you have to close your position. You must, right? So you've got to offer it down. If no one's buying, you keep going down, down, down. You get to zero, still no one's buying. At that point, the exchange clarified that zero was not the floor. This can go negative, and it didn't just dip a toe in. It dived headfirst down to $40, right? But it's a bit calmer today, and May, as you noted, does expire today. But I think you're right to look ahead to June. Sure, people have got more time to settle their June positions. The June contract won't expire for another month. But the same scenario is still sitting in the background. There's too much oil, not a lot of space to put it in. So what are you going to do with this price at Cushing in June? So yesterday, not surprisingly, the trade was focused on May and it was moving so fast. It was just dropping dollar, dollar, dollar within seconds. June was weak, but only fell, let's say, $4 or so, give or take, yesterday. But traders today are already looking ahead, thinking this scenario could repeat. Not that it will, I'm not saying we'll go negative in June, but the fundamental problem is not resolved. There's too much oil and nowhere to put it.
Well, Richard, you say that the fundamental problem still exists. Obviously, we have this oversupply coupled with the fact that there's just no demand out there for crude right now. So when do you expect to see the oil market begin to stabilize a bit?
That's a very tough call, isn't it? I mean, if you look at that recent agreement that OPEC Plus, or OPEC Plus Plus, if you like, if we're going to add in the sort of the US effort into that. So you've got major producers around the world agreeing the world's biggest ever production cut. And look where we are. It's done nothing to the price. We just kept going down. And it's not just the May price. It's the June contracts. It's Brent crude in the North Sea. Everything's coming down. Everything's very weak. So even the biggest concerted action by producers to stop this, to arrest this, and take barrels off the market and bring it back into balance is nowhere near enough. We have never seen a demand drop like this, never. So really, the supply side is struggling to catch up. It will catch up for varying degrees. It could be policy, or it could even be just economic signals. You know, who's going to sink new dollars into exploration and production with an oil price in single digits, right? Nobody. So the supply side will catch up, but there's a time lag. There's a time lag for this, right? Production doesn't change overnight. And unfortunately, demand is not going to pick up overnight either. Now, demand will pick up at some point. You know, we are going to start driving again more at some point as countries start the recovery process out of the other side of the coronavirus. But we're not seeing it yet. We've got a tremendous imbalance in the oil market. It's not going anywhere. And unfortunately, it's not just a theoretical one now. We're starting to run into these real nightmare scenarios of oversupply is not just a balancing item at the bottom. It's real barrels of oil that need a tank, and we haven't got space.
Yeah, there certainly will be a lot to assess here once the dust settles on the May contract and we flip over to June, obviously, because we're seeing losses there as well, like you were just talking about. Richard Swann, head of price reporting at S&P Global Platts Americas. Thanks for breaking all that down for us this afternoon.
Thanks, Sean.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.